Hello and welcome to Premier Study in Investing. It's great to have you. Thanks for stopping by.
Hey, thanks so much for joining me again for Premier Study in Investing. Thanks for all the thanks for liking and subscribing. I mean, I'm in between jobs right now. I don't know if I'm ever going to make a business out of this YouTube channel, but I'm learning a lot, and it's always fun to interact with different people, different ideas. So let's jump in. Well, we're going to be talking again about David Rogers Webb. He wrote a book about 6 months ago, the end of 2023. So what we're going to try to do today is take a segment of what David's entire argument is and look at the derivatives market. David says the derivatives complex is very, very large, that it's larger than the collateral backing it, and that its size alone could unwind the entire global financial system as we know it. Okay, I probably lose a lot of people right there. I mean, I don't know. It depends, I think, in my personal opinion, to even entertain these type of ideas, you already have to be pretty far down the road of we're in a mess. Something is kind of like real odd. We're in some kind of hybrid war, to borrow a term that David likes to use a lot. But some kind of infinite war is a term that we've heard before from Chinese CCP type of how to control people and billion people in China. So these types of things. If you can't entertain those types of ideas, or that society is somehow needs to be managed, right? A few people trying to manage the masses. Obviously, the numbers benefits is tipped way towards the masses. But how do you have these elite structures and kind of these hierarchies and people aren't, constantly just upset to no end? Well, let me try to very succinctly give you David's end game view here and why derivatives is important and why we should look at it. David's end game view is basically that nobody's going to voluntarily sign up for a CBDC, central bank digital currency type system. Nobody wants to say have the government or the Fed have all access to interest rates, all the purchases that you made, social credit scores, personal identification, and then no other options for lending. So a monopoly on lending and borrowing and rates and everything else like that. So because it's unpopular and people wouldn't do it voluntarily, David basically says that there's been a long sort of setup, legally and otherwise, in order to convert society into a central bank digital currency system. That part for me doesn't sound that unreasonable, because who would want to join some kind of system like that? And yet I grew up in a Christian nation, where a lot of Christians, churchgoers, have that as part of our eschatology, our end times view of what kind of happens towards the end of the story. I'm not sure about Islamic eschatology or Hindu, Buddhist, Sikh, Jain. I don't know. I'm not really an expert in those type of things, to be quite honest with you. But for a lot of people that I know, it doesn't sound like that far-fetched, and why people wouldn't be interested in a system like that. Yet, that's where David thinks this is going and what this is all about. Well, how are you going to convert everybody into this new system that seems unfavorable, like highly unfavorable? He thinks, well, you have to basically decouple. You have to demolish the current traditional finance and banking system that we have. Well, how do you do that? I mean, there's banks, from one sea to the other, to the north border, the south border. I mean, every corner, every street. I mean, how are you going to do that? And his answer is well, you have to bankrupt them all. That's how you get rid of them. You have to cause a big war, bunch of debt, a bunch of leverage, hence the derivatives market. But you have to bankrupt the system. And this is what this is all about for David, is that's what the plan would be. And then we would be offered sort of this relief package that we would, of course, be forced to take because, who carries cash, right? Who carries cash? And how many people, if the financial markets went down, they would lose, a large amount of their wealth. Whatever they have in stocks, bonds, CDs, cash accounts, mutual funds, money market funds, despite the people that do it professionally, swaps, warrants, derivatives, yeah, I mean, all kinds of stuff like that. So gonna switch off here. I think you get the basic idea of what this is, and that the point of what we're trying to do is look at a small part of David's thesis, which is the size of the derivatives markets and how it works. And even if you don't go along with David, you'll still have an idea of the derivatives markets, how it works. It'll be good. So let's keep going. An image of David Rogers Webb, and he's actually done a lot of work on Chris Martinson's website called Peak Prosperity. So go enjoy all the content that those guys have done together. But on top of that, there's also a YouTube channel, The Great Take. And so here's the video and the documentary and the channel, and it's clipped along pretty good. It was views. Hasn't caught a lot of subscribers, so it's not the greatest done documentary, honestly. Like, I think David could do a remake, but it's pretty good though. I just brought this up to say that, you know, David Rogers Webb is not the first guy that has questioned the Fed. This is one book that comes up a lot, The Creature from Jekyll Island, that I've not read, but Fed Up, Daniel DiMartino Booth, right? She's all over the place. The Great Devaluation, Adam Barata. This is more about like a currency reset, but similar. Ron Paul, I didn't know that he had a book, The End of the Fed. Lynn Alden, of course, she just wrote this in the last year. Broken Money. Haven't read that either. But The Tyranny of the Federal Reserve. What else do we have? Maybe the Lords of Easy Money. Probably. Maybe nonfiction or fiction, I'm not sure. But, I mean, you get the idea that this is not like the first time people have wondered and talked about the Fed in like a negative way. So that's a lot what this is. So one of the big questions that we need to look at is how big is the derivatives market as seen here? And I do want to read a couple of things from this. So gigantic, often estimated over 1 quadrillion. This is 1,000 trillion. Okay, so it goes millions, billions, trillions, quadrillions. So that's just the next iteration. I also don't always agree with everything here. So some market analysts even place the size of the market at more than 10 times that of world GDP. So, I mean, world GDP is something like 100 trillion. So that would put it at 1 quadrillion. But other folks, David Rogers Webb, put it higher than 1 quadrillion. There's two other points, but we're going to look at the Bank for International Settlements website here in a second. But it says, according to them, for the second half of 2021, the total notional amount outstanding for contracts in the derivatives market was estimated at 600 trillion. Again, second half of 2021, so that's old information. But the gross market value of all the contracts is said to be significantly less, approximately 12.4 trillion. I'm going to give you an example of what that means, the difference between market value and notional value, but it's important to get the difference. And if you've not been around derivatives, it will be sort of confusing to you until you see it. Before we go into that example, why is the gross value of derivatives far less than the notional value? It says many derivatives traded are executed hedges against existing positions in order to minimize risk exposures. So hedging is it's a risk minimization technique. Because of this, the total notional amount of outstanding derivatives positions can be misleading. Let's say you have 1 million stock portfolio and purchase put options on that same amount to hedge your downside risk. While the notional value of the put options is 1 million, the gross value is actually 0 since it's exactly offset by the value of the stock portfolio. I'm going to show you that this cannot be the case for most of the derivatives market. There's just no way. We know the size of the equities market. We know to a degree the size of the notional value of the derivatives market, and it's not like hedging is happening most of the time. It's just simply not. Okay, let's go over here and look at this is actually the Bank for International Settlements. Again, older information. Sorry for the scrolling, but this says the second half of 2022. You see notional value outstanding. Total, we're looking for the red line here, somewhere over 600 trillion. So this is in trillions of US dollars. And you can see how it breaks down. Foreign exchange is a big part. Equity, commodity, credit, other. So the Forex market is huge. Foreign exchange. It's just what we mean by that. So definitely interesting. We're learning, yeah. So it's really, really interesting. One more article from Investopedia, the notional value versus market value, what's the difference? And they're going to give us an example. So here's the example. For example, a call option representing 100 shares of XYZ stock with a strike price of 40 may trade in the market for $1.20 per contract. So per contract, there's 100 times the 1.20. You'd actually have to put up $120 to get into that contract if you were the buyer. So that'd be the market value, but represents a notional value of 4,000. And 4,000 is the strike price times the 100. So what you basically need to know is that when it comes to equity or stock options, the multiplier is 100. There's 100 units per contract. Let's go over here. I just drew this up. It's the same information, except for one little point. So we're talking about a call option, $40 strike price. This was chosen by the buyer. You could have gone a strike price by a different amount, but there's buyers and sellers for all these different contracts, and there's always agreed upon price. So in my example, I did $1.25 instead of $1.20, like it had in that Investopedia example. And like we learned before, an equity option controls 100 shares. So the price paid at initiation was the 125 times 100. So let's say I'm the buyer, I had to send over $125 to get into this. And usually it's taught that it's sent to a seller, but we learned from David Rogers Webb that it's actually not like you're my seller and I'm your buyer. Like we're not buying and selling to each other really. It's goes to like a third party through a clearinghouse. So there's like a intermediary between us. Because what if you go bankrupt? Like I still want to get my money, or what if I, same thing. You need to make sure you get paid as well. So there's kind of this third party to make sure that everything works out in case any individual goes bankrupt or can't make good on what they owe. Okay, so market price is $125 at initiation. This is 125 times 100. We already talked about this. Now the notional value, the same as what they said in the article, is it's the $40 strike, which was an arbitrary number, and I'll give you the example, but times 1,000 times 100 equals 4,000. So you can see the market price and the notional value are very different. How this works is, this is just the way we draw it. And basically, for me, the buyer, I'm making money in this green section up here, and I'm losing money in this red section. The way that we draw this out is we draw like numbers on a number line. So this is the stock price at 10, at 20, at 30, at 40, and then at some other number here. Well, we chose 40. I decided I wanted to buy a contract with a strike price of 40. I could have chosen a different contract with a different terms. Just like when you buy a washer and dryer, you can get like this package or that little thing that it does that the other ones don't do, or whatever, and the price adjusts accordingly. But I thought $1.25 for the 40 strike was a good one, so I got into it. Basically what happens is I had to pay $1.25 here, so I need the price to get to the 40 that I thought it was going to get to, and then I need to make back my $1.25 that I spent to get into this whole thing in the first place, which is why my green starts here. Anything above this would be 40, my strike, plus the premium I paid. This would be $41.25. Anything above $41.25, I'm making money and I'm happy. Anything less than that, I'm not making money. I'm losing money. Now, the other way that this works is that, of course, on the day that we started this contract, the stock was selling at something. They said they didn't give that information to us, but I just chose $30, for example. Okay, so it's trading when I bought the position, when I got into the position, when you and I made this agreement. I send you the $125 for one contract. I'm saying we're going to get to $40. I'm saying we're going to go up here. You're saying no, we're not. You're saying I'll take that deal. So I need a pretty big move. I need a $10, $11.25 move, and it depends as well like how long this is going to last for, this agreement. It may only last like 6 months. It could last a year or two. It just depends. But that would, of course, the longer the better for me, the more opportunities I have for the price to go up. I just decided, for an example, let's say that there's a big move, something like a David Hunter move, and it goes up to $55. We need a lot of volatility in this type of scenario for David Rogers Webb, the author that we've been talking about, for any of what he has to say to make sense. The reason I say that is because if I buy this contract here and the stock price sits right here on this yellow dot at 30 for the entire time, Nothing happens. I mean, I lose my $1.25 times 100. You keep my $125, and that's it. I got the opportunity to, make a lot of money if there was a big move. It didn't happen. It didn't happen for me, but I guess I was happy with what I got. I got a shot at what I thought was going to happen. And I didn't have to, shell out a ton of money, $125, $125. Well, let's say that we do get this big move. You'll see how crazy things start to get if the derivatives market is large. Like we'll learn it is. A $30 starting price up to $55, which I picked arbitrarily, is a huge move. Exactly what I thought was going to happen. And in fact, if we do the numbers, the stock price went up 83%, or at 1.83 times, x'd 1.83 times. So big move, huge move. Didn't quite double, didn't 2x, it didn't double, it didn't go up 100%, but up 83%. Well, let's say that I held that position and I got my option here. Well, it went to 55, but I don't really make all the money. I make the money after this blue dot, which is the 55 less the 40 less the 125. So I really made 1375, but of course we're going to multiply that by 100, so 2 zeros. I'll make $1,375 is what you'll have to pay me. Okay, this is a gain of 1,000%, and I 11x'd my money. Okay, it's the same exact move as far as the underlying. The stock, the equity went from 30 to 55. It had a huge move. But you could see the derivatives market really, really magnifies the amount of losses that you will incur and the amount of money that I'm going to make. This is why a large amount of volatility has potential to make a lot of money for some people and a lot of bankrupt people for others. Now, that being said, we still have to believe that it's big enough to bankrupt all the publicly traded banks. So let's see if we can even make any sense of that. But that's how a simple call option works. And you can see, obviously, the dramatic price differences in terms of return. I just want to point out one other thing here. I had to put up $125 to get into this contract. In order to buy 100 shares of this, I would have needed $3,000. Right? So I was able to get exposure to the same amount of money with a lot less capital out of my own pocket. So now you understand the notional value versus the market value. Again, the notional value was $4,000 and the market value was 120, or in my case, 125 for my example. Here, 125, 4,000. So the notional is really, it's the strike price that we chose, which was arbitrary. If we would have chose a $45 strike price, it would have been a notional value of $4,500. Okay? But that's how they're arriving at that notional value. It's important to understand moving forward. So this is a cool visualization of how large the derivatives market is, although it is a little bit old, 2022, and the numbers are really going to match up. It's going to be close to that $600 trillion. So the way that this all works is the visualization is one of these squares equals $100 billion. Okay, so a lot of this doesn't really matter, but there's about almost $1 trillion probably in cryptocurrencies today. I think it flirts with $1 trillion. This interesting gold has about 11.5 trillion, but this is also including gold-backed ETFs, so there's probably less physical gold than that. Central bank balance sheets are sitting at 28 trillion. That was a couple years ago, again 2022, and this is right. This is about 80 squares. The Fed is the United States Fed is somewhere like 8 trillion, maybe 7 and some change at this point. This is where it starts to get interesting because we're talking about the collateral, right? The S&P 500 is only 36 trillion. And remember, going back to outstanding OTC derivatives, are at 600 trillion. plus or minus 600 trillion. So even in like 2022, so somewhere in the ballpark of like 18 to 20 times leverage to go from the 36 trillion if we were going to use the S&P 500 to get to the notional value of the derivatives market. I don't think this is the best thing to use, so let's go down below here. There's we can find all the money that's in all the markets, equity markets. Global money supply, it's not really that important in my opinion, but this is what I want to look at, all the stock markets, and this is a lot more. I counted like these up, these are 40 across, and I counted down, I came up with 92 trillion in all the global stock markets. I understand a lot of this was foreign exchange swaps and things of this nature. Equities in the blue. So what would you say the blue is? It's about between 10 and 20 trillion, right? It'd be like 10 or 20 trillion in this graph for the equity derivatives. And so in that situation, they're actually the equity market itself, the shares themselves would be worth much more than the derivatives on that equity, which is good. It doesn't help us believe in David Rogers' Webb, his thesis, but it's actually less volatile than we would than it could be. Global debt, 300 trillion. It's owned by governments. It's by the financial sector. It's by households. And then you have real estate. Residential makes up 72% of the overall. So there's 326 trillion total real estate value globally. And 269 of the 326 is in residential. So almost 80% is in residential. Also interesting in light of some of those chats that we've been hearing about the commercial real estate market unwinding everything. It's only 20% of all real estate. Most of it's in housing. Interesting. Now, of course, there is a section of commercial real estate called multifamily, right? Apartments, which would fall also into the residential, could fall into the residential sector depending on how they group it. This says there's about 33 trillion in commercial real estate. Global wealth we'll skip. Europe we're going to skip. China, Asia Pacific. This is where the derivatives start to come into play. So this is where we're going to see the market value of 12.4 trillion. And we know that that is like this. It's the 125 in this scenario versus the 4,000. So this is, at this level, it's 32 times leverage. You can get 4,000 divided by 125 is 32. So 30 times leverage is not really that abnormal for derivatives. So we would expect, what's 12.4 times 30? 12.4 times 30 is 372 trillion. We do not have 372 trillion. We have down here 600 trillion. This is more like 50 times leverage. What's 600 divided by 12.4? It's 48.3 times leverage. And if you want to look at the blocks, you can start to see that there's a ton of blocks. Now, it's not all just equity. As they say, it's futures. It's forward contracts. It's largely for commodities. Options, like we were talking about before, put and call options, either hedging or speculative strategies on equity, on company shares of company stock. Warrants and swaps. Swaps is you can trade basically interest rates with people. Fixed rates is something that one person holds, and the other person has a floating rate contract, and they want to trade them out. You know, one person says, "Oh, I have this floating rate debt. I'd really like to lock it in at a fixed rate. Is anybody willing to do a swap with me?" And instead of doing swaps, you can just buy like a swap or a swaption. There's these sort of design derivatives to make that more convenient for holders of debt. But this is the notional value. And so the blocks visually, it's obviously by far the largest thing here. I will tell you, I do think that this is really interesting that the foreign equity derivatives is the largest part. I could see that being used by multinational companies that need to make some sort of assurances to not have real crazy swings in their income statement or their cash flow statements because of currencies flying all up and down on them. They're trying to buy products, they're trying to ship products, they want to sell products. Of course, they're going to use the financial markets to try to take out some of that volatility and have like a more dependable business. They're not hiring and firing people all the time and selling stuff at a huge discount because they had a bad quarter because they lost a bunch of money with the, say, yen or whatever other fluctuations they had in their currency exposures. So that's weird. I'm not sure what to do with that. It's odd to me that the equity section of the derivatives is so small. Also that the commodities is so small. It's almost all foreign exchange. So something to think about. Maybe a good question for David Rogers Webb to bring up. Now, one thing that David says is that it's 6 trillion here at 2022, but now they estimate it to be 4 times larger. So that it's increased to, 4 times. They put as high as 2 quadrillion, which would be 4 times, 3 times larger than this, what we're seeing on the screen. If we saw all these squares, and then we saw them again, and then we saw them again, and the actual amount of stuff, like the commodities or the actual value of money in the, say, markets, stayed the same, that would mean, this is what we're looking at, this is the 92 trillion. If they think that the derivatives market has gotten, say, 3 to 4 times larger in the last 2 years, so just making a note in my editing process, yes, if the notional value increases by, say, 3.5 times of the derivatives, then we would expect that the market value would change in line with that. However, the overall leverage against the collateral is more. The soybeans are the same, the output of cattle, the general value of real estate, the general market capitalization of the equity of corporations, all basically about the same. Meaning that the leverage increases maybe to 120 times. I guess if the derivatives market they said increased 4 times, this number would increase 4 times, and so would the 600 trillion go to something like 2.4 quadrillion, something like that. Now, to go back to this very simple example, it's no big deal. These options contracts really don't change that much in value. Maybe again, if you're the seller and I'm the buyer, maybe you end up taking my $125 and nothing happens. We never get here to this $40 strike or this $41.25, we call it a break-even point that I was looking for, nor do we ever get to any of this, right? So for sure, we need a big move for this to really matter. But if you get a big move, and these derivatives contracts say carry with them a 11x type of scenario, there's one other part you need to really think about. And this is not fair, but it's going to have to do for what we're doing. I'm going to draw here a distribution curve. And let's just do a bell curve based on 30. I'm going to say this is the same. This lines up with the 30 right here. And I need to do a distribution off of this. Let's just say it's something like a general, kind of not right over our old work. Something like a normal distribution, just as an example, right? Well, realize my $55 is way out here, assuming this is a fair setup. And obviously this is not drawn to scale. This is 10, this is 10, this is not drawn to scale. But I'm just saying, you would imagine that you have in normal distribution 50% chance for a downward move. Well, obviously that's not going to help me as the buyer. I need an upward move. So 50% of the time, at least, nothing's going to happen. And I need to get over here to 41.25. Now, let's say I drew this badly, but let's say 41.25 is somewhere like here. I mean, it's a big, well, I don't know. Let's just say it's here. For me, this now becomes the green over here, right? Just to make any money. And then to make really big money, obviously, like, I have to get really on this far right tail to make like crazy big money. It's not very likely to happen, right? For sure, 50%, say 70% probability is against me that I'm even going to make any money on this trade. And to make really, really crazy wild money, like a $55, like an 11x scenario, it's not going to happen very often. But, you know, David really then is forced to get into more sort of catastrophizing. Why? Because he believes that it's intentional. And so how long would it take to have an event like this just under normal circumstances? Well, I mean, I don't know. I mean, it could take years, but realize that it's not like this ever changes. There's always this huge leverage in our current system. As long as everything is pretty chill, most of these derivatives contracts, they might just expire worthless, out of the money, meaning you take my $125 and nothing happened. We could do that, you know, month after, I mean, we could do that contract after contract after contract for like 5 years. And as long as there's no crazy volatility, everything's fine. But then there's that one time when I make, right? I mean, when I make $1,375 off of you, right? I hit the 11x jackpot. Now, David says, yeah, that's not going to happen maybe like all that often in normal life. But if you have people that are trying to like set up a scenario and then, you know, start a war, do some kind of utility grid thing, some kind of, you know, nuclear bomb, EMP, sorry, that you could get these types of huge moves, right? An 11x move. And so the problem is let's just go with their more conservative estimate of, say, instead of 600 trillion in notional, let's just say it's 1.8 quadrillion. And let's say you get an 80% swing up or down. I mean, for most of the people, most of the contracts, it's not going to matter. But for the contracts that matters a lot, these are 11x. Obviously, nuclear bombs and stuff like that are bad events. But let's just say we'll do like an extreme good event, like people wanted to juice the markets up huge. So they like rolled out like a cure for cancer and like water on Mars the same day, right? And so they wanted to have like an 11x up move. That would apply to everybody. That would apply to like 50% of the market, because anybody who was like a little bit long, they would all make money. But so would all like the crazy people like this, the real extreme, deep out of the money people. And so these people, they would make the same like $13.75 here if it went to $55. But they would have paid a lot more than me. I only paid $125 to get into this. Some of them, they may have paid like $1,000 to get into their contracts. And so they still made $375, the difference. But it's the people who are betting on the huge moves, right? The kind of the long shot, the underdog bettors who, if they're right, they really beat the odds, they're going to make huge money. Let's do 11x on the 1.8 trillion. Sorry, 1.8 quadrillion times 11. Let's just call it, it's 19.8 quadrillion. But only half of those contracts will be in the money, so we got to divide it by 2. So it's something like $10 quadrillion. Well, $10 quadrillion. $10 quadrillion in this situation is going to overwhelm household wealth, 463 trillion. You're not even close. It's like half a quadrillion. All the agriculture, all the real estate. If you take all the real estate plus all the household wealth, you get to, let's say, $1 quadrillion. The rest of this stuff is just small change. 92 trillion here. It's like 92 trillion in the stock market. 326 real estate. 463, 326, 463. 326. 463. These are T's, trillions of dollars. You got something like 92 trillion in the stock market. You add these up, you get to, let's just be generous and say it's like 1Q with all this incidental stuff. I think that's how David Rogers Webb comes up with this. This is how you bankrupt JP Morgan Chase, Fidelity. Like there's no money on this graph anywhere that is going to be able to clean up 10 quadrillion. There's not that much money in household wealth, commercial real estate, agriculture, residential real estate. These are all debt figures. The financial sector, the governments, non-financial sector, corporations. So the $300 trillion in debt doesn't really help. I mean, that's somebody's assets, but it doesn't really stack up. You can add this on. This is the 92 trillion in stock markets. Money supply is not considered an asset. It's just the way that some of the assets are being held. China GDP 36 trillion in the S&P 500. Central bank balance sheets. So that's basically how he arrives there. I mean, that's the math behind the notional value and why, if you have something like 1.8 quadrillion in notional value, derivative markets here, and it hits something like an 11x move, but it only pays off for like half the people. It's more than the assets for sure. Obviously, I mean, we're talking about the same scenario to the downside, right? So David's argument then becomes that the people who Okay, back up. So one thing I want to note is something from this. So one thing I want to note about this idea of how much of this is hedging, it can't be very much. So I guess my argument, and you can agree or disagree, has been that if the notional value increased by 3.5 times to something like 2 quadrillion, so this number increased to 2,000 trillion, basically, that this market value would also increase by the same amount. But the thing that you really want to watch would be derivatives on the foreign exchange, which is currencies. One thing to know is that David is not suggesting that you go and you buy huge positions for a foreign currency collapse or some kind of equity collapse, and that you get ultra rich because of a bunch of derivatives that you bought, and you were right and you figured it out, and then somehow profited off the whole thing. His point is that can't be done because the bank and your brokerage are going to become insolvent. And whatever money you made on your awesome call with your derivatives contracts are going to be taken from you anyway in an insolvency because you hold a junior claim. It's not like advice to invest for some huge market bust and then sail off into the sunset. It is a formula for how to bankrupt the entire financial system and move us all into some federal digital bank central currency system where we would all be in huge trouble, right? It would be a lot of companies going bankrupt, a lot of corporations would have problems. I mean, David argues at some points even that the debt that companies hold and the debt that all of us have been, instructed to use because the cost of borrowing with debt is actually optimal. It's more cost effective than other methods of funding. Well, anyway, David says that the debt ends up being leverage used against all the companies and all the people. Like if you don't own your house full out and your bank goes bankrupt and no one wants to buy your bank and they are scraping together all of the assets that they can get in insolvency, I mean, they technically still own the house? I'm not sure. I'm not an expert in that part. You have some equity in it, but you obviously don't have 100% ownership. So, I don't know. I mean, I really don't know about that part, but it is part of his larger equation. Anyways, without getting into that, you can imagine that the overall way things would work would be a lot of people out of jobs, needing some help, needing some bailout thing, looking for, okay, the government has this new rescue plan. I download an app, I open an account, I use my social security number or whatever, photo ID, and I can start to draw funds from, my new central bank digital currency account until get back on our feet, get us through this tough time, this atomic bomb, this war, this massive financial thing, everyone's going to all scream and yell and sue their financial advisors. This is David's view. Demand their money back and reform and that, riots in the streets and all that stuff. But in the meantime, you're going to buy bread with this new system that you just bought into because all the banks are closed. The question we're trying to answer here today is the derivatives market large enough with the amount of leverage that we're seeing in these examples, assuming huge moves to the downside? In the screen that we have here, we're talking about moves to the upside. But if it was the same and you had a 10 quadrillion move There's no banks that are worth that. There's no equity that's worth that. So in closing, I'll just kind of say this. It's been an interesting journey to look at derivatives and how big the markets are, some of the ways that they work, just with simple examples. I think after just kind of like listening to myself kind of go over this and thinking about it, the example from the beginning still really holds true, that if there's 100 shares of some company, let's just say Baskin Robbins ice cream company, right? There's no limitations. There's no rules out there that says that, well, if the market cap of the whole company, say it trades $88 a share, there's only 100 shares out there, so just 8,800 market capitalization. This means this is the value of the equity for the entire corporation. So if someone wanted to come in and buy the corporation, you could do it with $8,800 in this simple example. Obviously, the $88 share price is believable. The 100 shares outstanding is the not believable part in today's market. Usually there's 100 million shares, sometimes billion shares. So, but it works for an example. So the whole company is worth $8,800. There's nothing that's stopping me and you from going on the side and saying, hey, you know what? I want to buy some option contracts. I think this thing is going to go great. I think we're going to find some people that have never had ice cream before, and it's just stock price is going to triple. And you're like, all right, dude. Yeah, like, you want to buy call options? Like, you're thinking, I'd love to sell this guy some call options, no problem. And we can do a deal. We can do a deal for 100 contracts, 1,000 contracts, 10,000 contracts. Nothing's stopping us. I mean, I just have to be able to come up with the premium money. And like I said, there are some regulations on you as a seller, because obviously there's not enough collateral. You obviously don't hold that many shares of this company. So you can't have like a covered position, we call it. And so I think that example helps us. And I also think the blocks are really helpful. And then also seeing that huge move in equity prices, 83% up move, can equate to something like an 11x on a derivatives contract. So I think it's really, really, really something to think about. And then once you see the size of the notional value of the derivatives contracts compared to the collateral, you know that it's not just hedging. There's no way that can all just be hedging. So without getting like all down to the very single nuts and bolts and trying to figure out every last dollar, all David Rogers Webb really needs to have happen for his entire thesis to kind of move forward based on the, say, bankruptcy of all he really needs is a few major banks to fail until he has kind of a domino effect, a systemic event on our hands. He just needs the derivatives contracts to overwhelm a few major institutions, and then the rest will just kind of all fall on its own. So how to end something like this? Well, how about reading the market capitalization of number of large banks? Citigroup, 119 billion. State Street, 22.13 billion, 22 billion. They were the ones that were the custodians behind Charles Schwab, who manages something like $7 trillion in financial assets. State Street has a market cap of 22.3 billion. Wells Fargo, 209 billion. That's the biggest one so far. U.S. Bank Corp, 64 billion. Bank of New York Mellon, 42 billion. Capital One, I like their commercials, 55 billion. JP Morgan, wow, 10 times bigger, $555 billion. Huge. Jamie Dimon in that group. Bank of America, very big. Bought up Merrill Lynch and after the GFC. They're worth about 300 billion, just under 300 billion. And that's what I got. None of those are worth $1 trillion in equity. No, financial institutions are a little bit their own beast, and they're not really valued the same way as typical corporations, non-financial corporations. But we've seen those go bust in the past. Okay, so here's the thing. Closing comments, right? I was gonna close the video out in a normal fashion. Hey, check out our website. Hey, we do Patreon. We're teaching you how to do modern portfolio theory, and you can learn how to make a portfolio of stocks and bonds and optimize it for the high Sharpe ratio and all that stuff. But the problem is, how can I say that if I'm even like basically on board? I mean, we do have all those things. If you're not convinced by David Rogers' Webb, then go check it out. It's probably the best. I don't know, it's the best, but it's been around since the 50s. But what I'm saying is, I'm not really in that camp. I more think that David does give us a compelling argument on the whole, and that the derivatives package seems to pretty much line up with his larger thesis that if you want to bankrupt a few banks, all you need is, I mean, I don't know, 5, 10 banks, I don't know, these global banks, to have a contagion effect. It seems like the derivatives market would be a good way to do it. Now, the thing that I'm stuck on, I can't figure out, and which unfortunately I'm going to have to go do some more research. You're going to have to go do some more research because I can't help you on this. Is that, does it make a difference that most of those derivatives are on currency pairs or Forex, foreign exchange? Because if you have a big economic downturn or some big problem, exogenous shock, you could see, I mean, okay, like we had in 2019, 2020, right? You could see that the broad market goes down, right? Everyone says sales go down, all the prices go down, investors pull their money and move it over to the bond market or whatever. You can see broad sales, like wide sell-offs in equities. But can you see that? You can see, and you can also see that in a currency pair. So say like we'll just do the yen euro, right? You could see one strengthen significantly against the other, but you can't see like all of the currencies go down. I mean, they're pairs. It's trading. How many walnuts can I get for a coconut? It's how many jugs of milk do I have to give you for a cheeseburger and a milkshake, right? I mean, they're currency pairs. They can't all like go to zero. They're currencies. So does that matter? So let's say half the currency pairs half the currencies get really strong, half weaken. So you have like this dominant set of currencies. The derivatives on those that were, bullish would go up a lot in value. I guess the people that were short on the loser currencies would make a bunch of money. Currency pairs. I can't see that it matters. It's hard for me to imagine that there'd be like huge swings in currencies, but I guess currencies are basically tied to countries, or the euro, Europe, but the pound, yen, yeah, they're all tied to dollars, which has something to do with the strength of the country's economy. I guess all the major currencies could go down in comparison to like emerging market currencies, like say whatever they trade in Niger or something like this, whatever is traded in maybe like Algeria. So that the Niger currency and Algerian currency could really strengthen compared to the traditional big boys. And if there's derivative markets on, those, there's going to be big winners and losers. I think all that really matters is you have huge distortions. I just don't know anything about currency trading, just to make a guess about whether that's realistic. To me, it makes perfect sense as far as equities, because that's what I spent so much time on. Same with fixed income. I can see big swings in interest rates and yields, and people talk about that all the time, especially in crashes. But we generally know that which direction it's going to go. They're basically going to cut rates, try to help for a rebound and recovery. So Well, that's all I have to say at this point. I think in general, David checks the box for me as far as derivatives, even though I can't explain all the implications of so much of it being in foreign currency derivatives. Foreign currencies is the underlying asset. I still think it holds based on what I know about equities. So if it doesn't, or if you think there's some reason that makes it an exceptional case and why the volatility in the derivatives markets that happen to be associated with foreign exchange would be significantly different than a huge shock to an equity market and the derivatives related to that, 11x, that type of thing. Then let us know. But otherwise, I think so far so good. I think David is making sense to me. Thanks for joining me. We'll see you next time. Thanks. Bye.